Hello, friends. In every aspect of life, there's risks, from economic, business, financial, to even social aspect of life. However, we as investors, we ought to understand the risks associated with the financial market. But in order to do that, we need to understand the risk personalities in the financial market. There are three risk personalities: the risk lover, the risk neutral, and the risk averse. Now, who is the risk lover? A risk lover is someone who is willing to take risks in an investment decision. This particular person looks at the returns associated to the risk. He knows that this particular investment is very risky, but he also understands that there's a lot of benefits or returns that could come out of this investment. So the person is open to what? Taking so much risk. These people, we call them aggressive investors. Now, three, risk averse is the opposite of a risk lover. This risk averse is always relaxed. Mm. This particular person does not like to take on too much risk. The person does not like risk at all. You get it? So if there's an investment that comes with even too much returns, as far as his returns are not guaranteed or his investment is not guaranteed, the person will not take on such risk. Now, neutral is someone between the two of these people, someone who is indifferent. He doesn't know if he should take risk or not. These people, they will usually take risks one or two times, then they'll relax. Yes. Now, after understanding these people, these personalities, we need to classify the market into different risk levels. We have the low risk level, the medium risk level, and we have the high risk level. In the low risk level, we have money market instruments. In an earlier video, I explained that a money market instrument is the one that guarantees payment of what returns. You know that you've kept 10,000 cedis. You know that at the end of the period, you'll get your money plus your interest. Repayment is what guaranteed. They are short-term in nature and they have what low risks attached to them. So we have example T-bills, we have fixed deposits, we have money market mutual funds. Now we have medium risk levels. We have a balanced mutual funds and blue chips. Balanced mutual funds is a mixture of what? A money market instrument and what? Equity market instrument. You understand? So the money you give to the fund manager would split the funds into half, put one in money market and put one in what? The capital market, so that the risk will be what? Balanced. A blue chip company, this is a company that is well established with huge financials, huge asset base, huge revenue, rich turnovers, very good turnovers. These ones, their performance are always guaranteed. Every year they make so much revenue, they make so much profit. So there wouldn't be any surprises when you invest in what? Blue chips. Examples of blue chips are MTN, we have Benso Oil, we have EcoBank, we have GCB. All these companies are blue chips companies. Now, high risk instrument, we have equity market mutual funds. Equity mutual funds, your fund manager decides to put your money into what? The capital market, which is a risky market. Two, we have what? Growth stocks. Growth stocks are stocks which have so much potential to grow. There's so much volatility in them, in its shares. For example, is Carl Bank. We have ETIs. We have Clystone. All these stocks are called growth stocks. So one day you see them at 2 cities. The next day you see them at 1.5. The next day you see them at 2.5. You see them at 4 cities. These stocks are what? Growth stock. Their prices are very volatile. One day they are here, the next day they are here. Very risky investment. And it also comes with so much opportunities. If it's going to bless you, it will bless you beyond imagination. All right. So before you put your money in the financial market, you need to understand the kind of investor you are. Are you a risk lover? Are you neutral? Are you risk averse? After identifying yourself, then you will not push your funds into one of these markets. If you are a risk lover, that means you are aggressive. You want to take on risk, then you have to invest in this place. High risk, that's equity mutual funds or growth stocks. If you are neutral, then I advise you to go into a medium risk, which is balanced mutual funds or blue chips. If you are risk averse, that is, you do not like risk at all, then you should go in for guaranteed returns, which is money market instruments, T-bills, fixed deposits, and what? Mutual funds. But before you even decide to do all this, you need to understand that the higher the risk, the higher the returns. So this one has low risk. That means it has what? Low returns. This one has medium risk. That means it has what? Medium returns. This has high risk, meaning it has what? Higher returns. Thank you for watching. My name is Apollo 11. Bye.